could do so now if you'd like.
Okay,
Move to
well,
more
it's 7:10 PM and we'll call the June meeting of the JRIB to order. And we're going to also, minutes we will approve at the next meeting. In case anybody hasn't had a chance to look at the last minutes. So I'm going to turn the meeting over to Josh and his team. And let you start with the performance report and then get into the education.
Yeah, of course. Definitely good to see you all. Most of us wore our short sleeves for the extreme heat that I'm not used to in LA. Before I dive into the performance, just a couple of actual housekeeping items. Yesterday marked the 1-year anniversary of us onboarding the portfolio of BlackRock. So we've been managing the portfolio for a year and a day. And so, first of all, big thank you all to the JRIB for entrusting BlackRock. We've definitely enjoyed getting to know you all, and we hope that you've enjoyed getting to know us. I know it's been a learning experience for all of us to kind of get up to speed. The education that we're providing, I hope you're all finding useful. And as we continue along this path, as Ken mentioned, looking at reviewing the SAA and the IPS as we continue on this journey together. Second order is we currently have a standing order to raise cash for your monthly benefits, just recognizing that there's a COLA going effective July 1st for the town employees. We still have enough cash that we're raising each month to cover the increase in benefits for the town employees part of the pension. So there's nothing to change, but something that we'll keep track of as we go forward is, more participants retire during the year. If we need to increase the amount of cash that we're raising on a monthly basis. Currently, we build up a small buffer that then goes to pay expenses, and actuarial fees, investment management fees, all and the like that comes out of the trust. So that's all been working in the background for the last year, and we'll just continue plugging along with that. And then finally, I know a couple of weeks ago, Caitlin Gilbert sent across the certificate of incumbency, the authorized signers list. This is just paperwork on our end. The certificate of incumbency allows the signer to enter into legal agreements. Currently, Carolyn Trabuco's the kind of top signer.
We'll keep her there.
Let's say the one person we probably do need to add is Ken as the chair.
Yeah.
David Becker is also listed. I don't know if
Not anymore.
Yeah, I was going to say I don't know if you need to update
Probably
that
Tom
as well.
Harris now.
So again, we'll have Caitlin resend that. She sent that to, I think, Caitlin Bossy.
I would think, let's go through Caitlin Bossy and I'll make sure we get it done.
And then once we update that, we'll also update the authorized signers. But Ken, you're actually an authorized signer. So if we ever needed to raise an extra $1 million, you could authorize that from BlackRock. That's really what the authorized signer list does. But we should just get everything in line as well. So that was a couple weeks ago. We'll send a reminder to check in. But that's the housekeeping notes. Jumping into performance. I'll start with the pension, as always, on page 4 of the materials that we sent across. The asset allocation at the end of May, continues to be in line with the targets that we have set. A really nice recovery. If you remember, the last time we spoke was at the end of April, kind of at the trough of this Liberation Day market sell-off. Assets ended up flat for the month of April and had a really nice recovery in May, up to $481 million for the pension fund. As of yesterday, closed yesterday, the pension fund was at $491 million. That's a monthly return so far in June of 2.6%, putting your fiscal year-to-date performance at 11.4%. So well in excess of the target 6.9 so far. Again, just on the backs of still strong equity markets, that recovery that we saw kind of with the delay in tariffs, maybe a bit more certainty, the ramping down of the retaliatory tariffs. Equities in May were up anywhere from 3.5% to 6.5%. US was up 6.5%, so US led the charge after being the kind of loser for the first 4 months of the year.
For what it's worth, based on my last report to the Board of Finance, they're going to be very happy with that.
I hope so. The recovery has been really, really nice. And this is a high watermark for the assets over the last 12 months as well. Again, looking back historically, the performance at the bottom of 4 is, through May 31st. So, I gave you that color in June on kind of the updated where we stand for the fiscal year to date performance. The individual holdings, again, you're predominantly passively invested. 85% of the assets are held in index funds, whether they're the collective Trust fund vehicles are the ETF vehicles that we've split in the pension fund. The tracking error, that active return is really a tracking error is relatively close to zero for basically every fund. And then if you look at that liquid portfolio green bar at the top again, that's tracking 85% of your total portfolio. We expect that the performance is more or less aligned with the overall benchmark. So a 1 month performance, that's the May performance, 3%, a little over 3 for the whole portfolio, that liquid portfolio of 3.3%. And on a fiscal year to date basis through May 31st, 8.5 for the whole portfolio. Again, if you add in the June to date performance, that's getting you to that 11.4 on a fiscal year to date basis. We did receive, I know the last time we spoke, there was no private asset updates because we were waiting on the 12/31 statements. Those statements literally came in the last week of May. So as of May 31st, we have asset values through 12/31 for everything. We actually have 2 of the funds, one of the HarborVest funds and one of the Mesirow funds. We actually got 3/31 statements as well. So that 1 month performance kind of captured a very lagged performance where we have statements just through 12/31. So the kind of market change is more attuned to what we saw in Q4 of the calendar year, kind of your Q2, if you will, the September to December update there. I'll pause. Any questions individually? If not, we can turn to 7 is the historic performance.
Just one thing, housekeeping, not numbers. You might have just overlooked. Remember in December, you added a first page that was a really nice summary. I'm just looking at it. You didn't do it this time. You might want to go back and just refresh. You had the first page had a really simple summary of the pension and the OPEB.
Okay.
By client, it just had equities, bonds, alternatives, and the returns. You can look at it in the December year end. I thought it was terrific and very helpful.
Okay, so we'll add that back.
We could put that back. I'd appreciate it.
Yep.
Okay.
Definitely. On a historic basis, that's page 7. The drivers really of your performance, even on a fiscal year to date basis, is that equity return of 11.5%, your private markets portfolio of 6%, fixed income 4.8%. We look even further back historical, looking at 5-year historic return of 8%. Big drivers again are equities and your private markets. We've brought a number of private equity experts here to talk about that, but long-term historical performance in private equity has been very strong. 17% over 5 years, over 10 years, it's 16.6% return, has been a decent driver of total portfolio returns, with your equity long-term return kind of near 8.5%. Not to dig too deep on 8, again, Annie and co will have a little bit of a diagnostic on your legacy book a little bit, but this table outlines capital calls through the valuation dates. The report date column to the right-hand side includes cash flows through May 31st. So there's been a number of distributions from the Mesirow funds that we've seen. We've made 1 capital call on some HarborVest funds, but for the most part, it's been more of a slow distribution from a couple of these funds. And again, this continues to get updated, but has that lag data. You can see the valuation date column where we have the most recent statements as of May 31st. So a bit of a delay on some of these managers. Usually that's kind of their lag is their fiscal year ends of 12/31. They tend to be a bit quicker intra-quarter during the year, but those will continue to get updated. And then finally, last bit on the pension on page 9, just target allocations. We look at the table of numbers. Again, we're more or less in line. We're not actively trading this portfolio intra-month. We tend to adjust the portfolio at month end when we're raising benefit payments. We raise $2.75 million on a monthly basis for the pension fund. And we usually look at where we're overweight or underweight to make that adjustment. So we raise capital from there. There's also within each liquid asset category, the equities and the fixed income buckets, that's 75% collective fund, 25% ETF targets. These are obviously scaled then to the total target allocation that we have within here. And again, there's some drift. We're not actively trading back between CTF, ETF to make sure that we're at that target. But if it tails outside of kind of 1.5% either way, we'll rebalance that. And again, in a month, at the end of June, if you're still kind of plus 0.7% on some of the ETFs. We'll use the ETFs to raise liquidity, to raise the capital. But that's kind of the just goings on of the fund, the mechanics of kind of rebalancing. And then quickly through the OPEB on page 11, similar story to the pension fund. Obviously, April was the tough month with the drawdown in capital.
Josh, this is purely from my own understanding. If the ETF and the CTFs are out of whack, 1.5% would seem to be fairly significant if they're.
Yeah, I wouldn't expect that. But again, it depends on where we've raised capital the month prior. If we've raised capital from the CTFs, for example, we may, as we try and get it back to balance, it might be just a little bit of drift. The benchmarks of each of these funds are slightly different. So there's maybe, 10, 15 basis points tracking difference between the ETF and CTF benchmark to begin with. So there's, it's a little bit of noise, but again, I think 1.5 is probably an exaggeration of how far off I would expect that they would get.
It sounded bigger than I would have guessed.
Yeah, but it depends on where we've raised cash from the month before.
Thank you.
In terms of the OPEB, similar story, really nice recovery in May. The OPEB has 10% higher allocation to equities. So we expect especially when equity markets rally, you expect the OPEB performance to be better than the pension fund performance. There's also a difference in the private markets composition. The private equity piece, the OPEB is only exposed to the HarborVest funds, which are kind of in early stage, right? The first vintage is 2021. As again, Annie and team will talk you through about kind of the dynamics of early stage versus later stage and harvesting of private equity. We would expect the private equity performance of the two portfolios to be a bit different because the pension has all the legacy pools as well. In terms of performance date, again, as of June 24th, the OPEB assets were at 101.3 million. That is a 2.5% return so far in the month of June, with their fiscal year-to-date performance at 12.4%. So that very strong year that we may have been thinking about in April as kind of having a different outcome off the backs of a nice May 4.3% return, and June 2.5% return is going to get you to that 6.9% expected return target. And then just finally quickly through the individual holdings of the portfolio, the OPEB only holds the ETFs. These are the same ETFs that you find in the pension fund, but 100% of that of the liquid assets are allocated to ETFs here. So there's only one fund within each sub asset category. And again, as ETFs, you tend to expect them to track the benchmark a little bit. There's a bit more noise in ETFs just because of the fair market value that iShares pricing and ETF pricing uses. They price at 4 p.m. New York time, and an international fund, for example, the index closes 2 a.m. So the individual indexes close at various times. So there's a bit of a disconnect sometimes on that non-US equities, especially ETF allocation. But again, for the most part, in line with what our expectations have been. And then page 13 is the private markets. In just the 3 HarborVest funds, we got updated statements for them as of the end of May. So some of the performance in there includes kind of updated NAVs, a nice write-up on the 2023 fund early on in the days that we took over is why the performance on the 23 fund is so great. You don't have a very large NAV in it so far. And so a good outcome for one of our holdings is good for overall performance. And then the historical.
Could you just repeat that again? Because I know I'm going to ask that question next time.
Yeah, you look at like HarborVest 2023 has a fiscal year-to-date return of 28%.
Right.
And a lot of it is they were calling capital throughout the last fiscal year. We started at a beginning NAV that was under 300,000, and if one of their portfolio companies they write up, they were able to IPO it or whatever, the markup value is on a very small denominator.
Got it.
So the return looks significant, but at the size of NAV for your portfolio, HarborVest 2023 is less than 0.5% of the overall NAV, so not as impactful on your kind of total portfolio return.
So that indicates that our balance is small. That doesn't mean the fund is small.
No, you're one of many investors within the HarborVest funds, right?
No, I understand that part, but we just happen to be new into that fund.
No, the 2023 fund is relatively,
But then I don't understand why our balance being small. I don't know why that answer would make sense.
because the NAV holding, they haven't called all of the capital. If we turn to page 15,
Right, no, I get that part, but,
so the return is just based on the actual market value of the investment. So you still have all this uncalled.
but is it a relative thing? I mean, what's the difference?
So the return is based on what's been contributed,
Mhm.
not based on the not based on your commitment. So
Right.
since the fund is still so small, if they have one positive outcome early.
Oh, it spreads over the whole smaller.
Yeah, yes,
Okay.
and as the thing that's interesting about private equity is as they do new deals, typically these funds have a 5-year investment period where they call down the commitment over those 5 years as they do deals. And actually, the Harbor Best funds are invested in primary funds. So those funds have a 5-year investment period and they are going to call down over 5 years. So that window is actually quite long. And as they're doing new deals, those investments come into the fund at cost. So they'll be held at 1x. So actually, if that fund adds a new investment that's big and it's at cost, the performance is going to come down. It doesn't mean as much. It's really not that meaningful early in its life. Does that make sense?
Yeah.
And I think the point too that Josh was trying to make is that fund relative to the rest of your NAV, it's Harbor Best represents a small portion of your entire portfolio.
Oh, that part, no question.
Yeah.
I'm just, this is partly my own question, but partly because I know I have to go quarterly before the Board of Finance and
Yeah.
explain things. And somebody's gonna say, hey, what's going on here with 28%? So I'm just trying to have
Yeah.
an answer that I can give them. So, okay.
Do all three of those Harbor Best funds only invest primary?
No, those funds invest in primaries, secondaries, and co-investments.
Okay.
Primaries is the main piece, but there is an allocation to secondary transactions as well as co-investments, where they're investing directly in a company, usually alongside a sponsor that may be in the portfolio, may not be in the portfolio.
And I think, Josh, you were just speculating responsibly about it being one transaction. We don't actually.
Yeah, it could be more than one, but it's
Right.
early stage.
It's a reasonable
Investments.
guess.
You know, they're not gonna have like a 50 portfolio book 1 year into calling, less than 10% of capital. It's 9.5 at March 31st. There's not much to add on 16, kind of the portfolio. There's much less levers in this portfolio, given the liquid bucket is only 4 individual funds. And again, trying to keep those relatively close to target. There's no cash being raised from this portfolio, no benefit payments coming out of the fund. So there's less of a need to draw capital. And so we tend to just rebalance at the same time that we're rebalancing the pension fund, just trading both portfolios at the same time. With ETFs, it's pretty liquid and nimble on the day that we're doing it. So with that, that's the last of the performance. I don't know if there's any questions, further questions on the portfolio performance. The next time we'll have a full fiscal year picture, though. Again, through June 24th, a pretty strong outcome, barring kind of 2 more days of trading into the end of the fiscal year.
Can I just ask a question on how you set this up? Are these with all the investments or any of these, where's the composite? Or
Which-
not the composite, where's the benchmark?
Which
I'll take 12 and 13.
12 and 13. Yeah, so with 12, so we have been measuring the portfolio relative to that green bar, the liquid portfolio that makes up 80 or so percent of the assets in the OPEB and 85 in the pension fund. That's your primary kind of your allocating relative to basically a broad 65-35 or 70-30 in the OPEB is close to 730. I would use that as kind of a primary benchmark. It's hard to tie in a private equity benchmark that only gets updated quarterly. So when tracking this on a monthly basis, we tend to look at a liquid portfolio. One of the broader education topics and things that we want to cover in our August meeting, which is where we're going to go over kind of risk objectives or risk tolerances, investment objectives. One will be discussing kind of a broad market benchmark for the total portfolio, just to measure it against kind of what your target is, something that will put a stake in the ground when we update the SAA or provide our take on what the SAA is. If there's no change, we'll just measure relative to what is the right kind of liquid, broad market portfolio for you to kind of benchmark overall against. It's hard to have a private equity piece, 10% of your target portfolio is private equity. That's not monthly updated performance number. And so that leads to lags in being able to compare the performance. So right now, the way that we're measuring the portfolio is comparing the yellow line at the top of 12 to that liquid benchmark performance in the middle of the green bucket. So slight drag relative to the overall liquid portfolio as a whole for the year. Some of that is driven because you have real estate in the portfolio that has not kept up with fixed income or equities. Private equity on a 1 year basis has not kept up as well with the equities. And so there's a bit of a drag relative to this liquid portfolio benchmark. But again, most of your assets are just allocated to a broad index equity and fixed income assets. So you should keep relatively close to those liquid portfolios.
I have a similar question, building on what Carolyn was just saying. And actually refers back to my earlier question. I'm looking at on slide 12, US equities versus the benchmark versus the iShares realized values. It's the same to the dollar. I'm just curious, wouldn't there be some kind of frictional?
On which one?
Sorry, I'm looking at slide 12, US equities, the benchmark, and then iShares, the realized value. I just want to understand. I'm just wondering, it seems like it is to the dollar, and that just seems unlikely to me. So I think I'm.
Tom, can you explain the question, just so we?
Yeah, I think he's saying the third and the fourth line.
yeah.
Match exactly.
Oh, yeah, there's a shading issue. That US equities is your total US equities. You only have one fund, so they should be the same, the US equities and the iShares. Because you're only US equities invest, there's a shading issue on the page. There should be another shade for US equities.
It's
I'm not-
to know what's the investment and what's the benchmark. Is there a way to mark this?
I realize an
Yeah,
ETF and a
We
benchmark.
brought this up a couple of times. We got to figure out a better way to.
Yeah, so your funds themselves, so the iShares Core S&P Total US Market ETF.
Yeah.
That's the only US equity allocation.
Yeah.
That fund is benchmarked to the S&P Total Market Total Return.
And let me just interrupt at that point. To the dollar, they're the same. I would just think with ETFs, you'd have some $5.
No,
differential.
Tom, he's saying that, excuse me, he's saying that the only US equities that we have there is that iShares.
Yeah,
No, I get it.
if we turn,
How could it be?
if we turn to page
Because
5,
if one is, if you're trying to replicate the S&P with an ETF.
Tom, no, he's not saying
Yeah.
saying that. Okay, if you look at that top line, U.S. equities, the total bucket of our U.S. equities is like 39.544 million. He's not saying that's the value of our portfolio if it was invested in the total return index with no fees. That's just the value of our portfolio. Go down a line. What is that made up of? It's only made up of the iShares Core S&P ETF, which is 39.
It's not a benchmark.
Right.
yeah, if you turn,
544 million.
yeah,
And
yeah,
then look it down at the next line, non-U.S. equities, 23.725. And then what's that made up of? Only of the MSCI ACWI ETF, 23.7.
Looking into my question, I didn't understand something. And
Yeah,
I
it was just-
was right in not understanding.
But Tom makes.
Yeah. we can, we will with the formatting. We've got to make this a little clearer for you.
You could, I mean, I'm just thinking out loud, you could just put a big star next to anything that, what we want to know is what we own versus some theoretical benchmark, right? And I think there's a lot of ways to do it. Shading seems to be a little tough, especially when it's printed.
Yeah.
But I think a big star or a theme for benchmark or something.
Yeah.
Might be helpful, but you know what? These are the kind of things we iterate and experiment with, and we'll get a good place soon enough. So, does anybody on the board have any further questions regarding performance for either the pension or the OPEB? Okay, I'll take that as a no. Why don't we move to the purpose of the gaggle of guests we have?
Yes. Yes, I'll just pass over to Annie here. We brought members from a private equity team, so I'll allow them to introduce themselves. But again, the second agenda topic being a private equity overview, asset class review and education session for board members, no one better to do it than a private equity team. So, Annie.
And I would just say, like, it's really hard to, learn everything about private equity in this one session, right? So we're gonna hit the highlights
Yeah.
of what we think is really important, but there's tons of resources that we have. I don't know if you showed the BlackRock Educational Academy, that you could go on there too and learn a lot about private markets, private equity, et cetera. So, but today we have our team here live, so, they're gonna hit on everything.
Yeah, it's great to be here. Thank you very much for having us. Maybe I'll just start with it. I'll introduce myself. You guys can introduce yourselves. And then I'm going to spend just 1 to 2 minutes of telling you what our team does, how we fit within the BlackRock ecosystem. Then I'm going to talk about why we think private equity makes sense in a portfolio, why we think it's in your portfolio, and why other institutional investors and even now retail investors are including it. Then we're going to talk about what private equity is, how the deals work, we can talk about the J curve, the life of a fund, the life of a deal, how returns are underwritten. And then Kyle and Thomas worked on a diagnostic of your portfolio, so we'll actually talk through that. And then there's some cash flow modeling that we've done as well.
Right.
So to start, my name is Annie Moore. I'm a managing director for BlackRock's Private Equity Partners team. I started with the group back in 2004 as a summer intern when I was in college. And then I worked with the team from 2005 to 2008. I spent time on the investment team. I left for 12 years. I got married to a Boston guy, so I moved to Boston. I went to a different company, and then I returned to the team in 2020, which is nice. So it's so wonderful to be back. And Kyle and Thomas are both on the team that I'm on. Kyle, do you want to introduce yourself?
Yeah, Kyle McDermott joined the team in 2019, working closely with Annie and do a lot of work on different quantitative modeling and research within the PE industry. So happy to be here today.
Kyle, Thomas Chaffee. I've worked with Kyle very closely on the modeling as well, started in 2020.
Okay, so I'm going to jump around a little bit in our deck. Let's go to slide 34 to start, which is sort of just the who we are piece of the puzzle. So we are part of Private Equity Partners. Our group was founded back in 1999. Our founder ran the private markets portfolio for AT&T. So institutional background, and he was very big into co-investments, which is a component of your portfolio in the HubbleBest funds. And he sort of brought that ethos to our team when he founded the group in 1999. We were originally part of Malim. So when I started in 2004, we were I was part of Malim. BlackRock acquired all of Malim in 2006. And so our team went over to be part of BlackRock, and we found a great house. The past 20 years 19 years being part of BlackRock has been really tremendous. There's a lot of synergy and resources, power of the BlackRock platform. Since our inception, we've raised about approaching 55 billion in LP commitments. Our team is about 200 people, and we have 350 institutional investors. In terms of what do we do? So how do we execute private equity within our team? There are 3 main pillars to our strategy. We invest in other private equity primary funds. So we are an LP in private equity funds. So think of KKR and Blackstone and Advent and PAI and Clayton, Dubilier and Rice, all of the top private equity firms. We are an LP. And we do that through fund-of-fund programs and as a strategic partner to large separate accounts who bring us on as an extension of their team to help them access private equity. We also invest directly in companies. That's the direct co-investment piece. We have invested since our inception. We've invested in 362 companies. We've put $17 billion to work. And we review, in terms of our deal flow, we review around 250 deals a quarter with a 3% selection rate. Typically, we're going to go through sort of the spectrum of private equity, but on the direct side, we invest in growth stage companies. So that would be like a Series C, and we're going to talk about what we mean by that. But Series C all the way up through distressed and special sits, buyout really being our core. And then we also do secondaries transactions. The secondaries market is interesting, and that's sort of it's been around for a really long time, but it's sort of more up and within the past 5 to 10 years, it's really been more up and coming. Secondaries, there are 2 types of secondary transactions. One is when a limited partner, so someone that's invested in private equity funds, is looking to get out. Now, there's no market for that, no public market for these interests. So you hire a broker and you sell your LP interests sort of in a privately negotiated transaction. And typically they trade at a discount to NAV. And there are secondaries transactions in your portfolio. you're in a secondaries fund. Lexington is a great manager in the secondary space. The other type of transaction, and these have risen in popularity given sort of market dynamics, are continuation vehicles and sort of GP-led transactions. And I'm not going to go down that rabbit hole right now, but I will come back to this and give a little bit more explanation on what this is. But our team does that as well. Are there any questions on what we do? Maybe I'll pause there. Yes,
Actually, just when you say we,
yes.
you mean we on behalf of your like us? Or do you guys have an investment, like
Yeah.
or does BlackRock make investments as a firm,
Right.
like a Goldman Sachs would invest in deals for themselves?
No.
As well as for customers?
No, this is all on behalf of our investors. And we have investors, we have three flavors of funds. We have commingled funds, which are similar to the Lexington Fund and the Harbor Best Fund that you're in. So we go out and we raise a limited partnership, a private equity fund that has a strategy, and lots of institutional investors will participate. For example, we raised a co-investment focused fund, so strictly investments in direct assets. We had a final close 2 years ago on 1.8 billion. We raised that fund for 18 months. We gathered 8.1 billion, and then we are now investing that in companies on behalf of our investors, institutional investors. The other flavor is separate accounts. So this will be where a public pension or an insurance company or a very large family office or an endowment, we have all of those types, will hire us to create a fund specifically for them. So these are much larger investors. They typically start at 200 million. And we can design any strategy. We can invest in funds on their behalf. We can invest directly in companies on their behalf. We can do secondaries on their behalf. So that's the second flavor. The third flavor is we have a 40 Act registered tender offer fund that invests in co-investments in secondaries. This is all on behalf of investors. We're not investing BlackRock balance sheet capital.
Yeah, to be clear, like the BlackRock balance sheet is really, as you've seen it last year, the acquisitions, a lot of it was in stock, but some in cash. That was balance sheet. And sometimes just to seed a fund, a new fund starting up, but just temporary until they get started and more investors come in. So those are a couple ways that we use our balance sheet, but not for really investment purposes like you see at Goldman or Morgan Stanley.
That's a great point, though. I want to make two comments on that. One, when BlackRock does make acquisitions in the private space, you may have heard about BlackRock's acquisition in Preqin. They talked with us about that. They spoke with our investment team to get our thoughts on the transaction. So we do play a supporting role when the firm is looking to do that. But the firm does most commingled funds have a general partner commitment. So what does that mean? When investors are doing due diligence on a fund and trying to decide what fund they're going to invest in, they want to see that the general partner, meaning the private equity fund, the managers of that fund have skin in the game. So they want them to commit to the fund. So BlackRock does that. So BlackRock does commit to our commingled funds, a percentage, maybe 2.85%, something like that. And yes, so there is a small commitment to show alignment of interest with our
But then
other
there should be a
investors.
conflict.
No, there's never a conflict of interest. It's just alignment. It's just alignment. Like we think this is a great investment. We're putting our money where our mouth is. The firm is invested. Yeah. No conflict of interest.
No bankers at BlackRock.
Yeah, that's exactly right. We are a pure fiduciary. There's no our goal.
I think that's what I'm trying to get at.
Yeah. No. We pure fiduciary. Our mission in life is to generate returns for our investors. Yeah. Okay. So that's what we do. Let's talk a little bit about private equity, a little bit more about private equity and sort of what it is. So I'm going to go back to the beginning. Actually, before we do that, let's do why private equity, why investors might consider it. So I'm going to go to 31. Okay. I think you can boil down the reasons for why private equity into three main categories. I'm going to start on the top right side with diversification. If for nothing else, we think that having private equity in your portfolio makes sense for a diversification purpose. When you look at all of the companies with $100 million of revenue or more, which is really the hunting ground for private equity, 86% of them are private. There are around 160, globally, there are around 160,000 companies that sort of fit within that bucket, and the vast majority are private. So just to have diversification with an overall equities book, and we believe in this, you know, right now we believe in the convergence of public and private equities, that at the end of the day, an equity is an equity, you know? And so like, we're not saying that private should replace public, but it should be a complement, and that it should live within the city portfolio. There are some really interesting trends at play. The number of, if you look at the number of public companies and the number of private companies, the number of public companies has actually come down by like 30%. Companies are staying private longer, and there have actually been a number of take privates, companies looking to go private. It's hard to be a public company when you're managing to a daily stock price and you have disparate shareholders and maybe not the best alignment of interest with the board. So like the number of public companies, we actually have a graph, it's not in here, but we have a graph that shows that the number of public companies has come way down. The number of private companies has come way up. So we would say that from a diversification standpoint, it makes sense. Now, back to the point that I made about companies staying private longer. This is really interesting. Okay, so if we use Amazon, so Amazon IPO'd in 1997, 3 years after it was founded. Does anybody know what it IPO'd at, what its valuation was in 1997? It was 438 million. That was its value. It's 1.9 trillion today. So all of that value creation, it went to the public investors. Now there's been sort of a secular shift and a change in that dynamic. Companies are staying private longer. For example, Stripe. And Stripe is in our portfolio. We're an investor in Stripe. Stripe was founded in 2010. It raised capital in 2021 at a $97 billion valuation. And then we came in 2023 when it raised capital at a $50 billion valuation. And that company's doing great as a privately owned company. And it's actually it's now cash flow positive. It's sort of transverse that, you know, it's gone from cash flow negative to cash flow positive, and it's doing great. We think eventually it will IPO, but it's not clamoring to do it. So we think that's a reason that it's important to have, you know, to be invested in the private markets. And actually the median age, if you look at companies that IPO'd in 1980, the median age to IPO was 6 years, and now it's doubled up. Okay, so that's one main point. The second main point is
Just interesting.
Yeah.
Would you say that is a chicken or egg issue? Meaning, I'm just thinking.
Yeah.
There's so much private equity assets and funds and so forth. It's providing a lot more funding to these companies that they can stay private.
Yeah, that's part of it. That's part of it. That's part of it. That they don't need to seek public markets to access capital.
Right.
That's definitely part of it. Yeah. But you know, there are lots of ways that these companies can generate a liquidity event for their investors. It doesn't just need to be the public market. There are, you know, when we're underwriting a company, we want, you know, an IPO is great, but that's actually our least preferred method of exit. We like when the path to exit is sale to another private equity firm or preferably sale to a strategic. They tend to pay the most because they can, because there's synergy, right? So that would be our preference. Okay, so performance. This is an important point. Okay, so the first was diversification. Just have diversification with your equities book. The second point is outperformance over and above public markets. If you look back through time over the past, you know, close to 20 years, private equity has delivered 2.6. This is median private equity. You know, close to 300 basis points of outperformance over and above. I believe this is the MSCI World. And if you can get into the second quartile or the top quartile, it's significantly more than that. Significantly more than that. And that's obviously the goal of private equity, is to invest in a manager that has access to top quartile funds. So that's, and we actually have an interesting, so some people say, well, if you look through cycles, does the outperformance persist? And we would say that yes, it does in this chart. And we have another chart that shows, I didn't bring it, it's not in this deck. But if you look back at the multiple, so there are two ways that we gauge performance in private equity. There's an IRR, an internal rate of return. It's an annual figure. And then there's multiple of invested capital. If you look back through cycles, top quartile private equity has generated a 2x basically over every cycle, or close to a 2x over every cycle. In some cases, the hold periods have been elongated, meaning that the IRR has come down a little bit, but it's generally consistently provided a 2x return on capital.
Am I reading this right, that the 75th percentile is significantly underperformed?
Yes, you don't want to be that. Yeah, yes. So the yellow blob represents the third and second quartile. And then above the yellow would be the first quartile, and below the yellow would be the fourth quartile. You don't want to be, that's why manager selection is critical in private equity, because you really want to be in the second or first. You want to beat the median. And one of the things that an institution does when they're trying to pick their manager is really extensive due diligence. It feels like an invasive medical exam sometimes. And we do this to the general partners and the companies that we're exploring investing in, like an exhaustive due diligence process. And I'm happy, I wasn't planning on talking about this today, but I'm happy at some point to talk about what our due diligence actually looks like and how we slice and dice the data. And then the third point is lower volatility. So private equity is typically, if you look, actually on this graph, we show, I guess, 5 crises that we've experienced in the past 25, 30 years. Private equity, the volatility that private equity experiences is about half that of public markets. Private equity gets valued on a quarterly basis. So you're not dealing with sort of the intra-quarter craziness. For example, when Liberation Day happened, we didn't experience any problem because the assets are valued quarterly. The last point that I'll make, and I think this sort of supports the diversification and the performance thing, the performance point. But if you look at the sectors that private equity is tilted towards and venture capital, there are certain trends within healthcare, within technology investing, within AI. Those are all born in the private market space. So there are certain trends that you'll just miss if you don't have exposure to private markets. I read some stat from a private equity firm that invests in enterprise software. So this might be biased because coming from an enterprise software private equity person, but he said that 98% of enterprise software companies are private. So it's just, you need to be invested there in order to gain exposure to those types of companies. Okay, any questions on the why private equity point?
Anybody on the screens have any questions?
No? Okay.
I just have a lot of a request, and we don't have to get into it right now, but I wonder if the issue of measurement bias versus actual volatility is an issue with private equity returns when we spoke more.
Okay, that's a question for Kyle. You say bias, I look at Kyle.
Like I said, we don't have to stop right now.
Okay.
No, you're asking.
Using the market.
We're great.
What's the question? I'm sorry.
If we only mark to market quarterly versus having the volatility of a continuous pricing model, you would think the volatility would be lower just because you measure only periodically. So I'm wondering if talking about
maybe in the short term, but
Wow.
longer term, it should, capture, what's in the market, right? But
Yeah, I think that's right. Typically, when we look at the volatility, I think over longer periods, it hovers at, on this quarterly basis, 13%, where say a public index might be closer to 17, 18%. Certain academics, including our own BII team, they will take into account the underlying leverage and almost try and de-smooth that volatility. The de-smoothing, some academics take a haircut of an additional 500 to 600 basis points of volatility that's added from that added leverage. I think our BII team, it's even more. I think it's closer in the range of 30% volatility.
But maybe to Tom's question about the quarterly valuations, I mean, if each of these individual scenarios, right, covers a whole time period. So look at the interest rate hike. That's an entire year's worth of performance. That public market equities over the course of 2022 were down closer to 20%. Private equity was down closer to 10%. That would be a 50% drawdown that you miss by having private markets within your portfolio. That's I think the point that Andy was getting at in terms of not day-to-day volatility.
But I don't think, and correct me if I'm wrong here, Tom. I don't think that's what Tom was trying to get at. I don't think, because I think he's asking a good question.
Yeah.
Which is, I'm sorry, is that I actually don't like. I think we've talked about this. So you mentioned that the Liberation Day didn't get captured. Well, it didn't get captured simply because the Liberation Day happened in the middle of the quarter.
Right.
If it happened on the last day of the quarter, it would have been captured. because if there's honesty in the way these things are
Right.
valued, it would have been marked down just like everything else was.
Okay.
So I do think that personally, this is a personal opinion, because this is definitely something that's bandied about. I've heard this from regular brokers, they always, trying to argue for private funds because, don't have the same volatility. Sure, they don't tell you the numbers,
Yeah,
but it's happening
Yeah.
one way or another. And we can put our head in the sand, which is what I think that's what you're asking.
Yeah, it is.
And we could say, oh, we don't have volatility because we're only seeing it once a quarter. But
that's not the only reason.
Like,
yeah,
the Liberation Day, if you were in the public markets, you experienced that volatility those days, right?
right.
But we've had a bounce back from that. And so if you're here in private equity in March, and now you're looking at in May, you had a lot of volatility between, but you've had a bounce back, right? So you didn't get that.
Not to belabor it, but just to push back a bit.
Yeah.
We are, let me actually give my opinion differently. How's this? We're a pension fund of fairly intelligent, mature
Yeah.
people with a very long investment horizon.
Right.
Yeah.
So the truth is, we shouldn't care about that kind of little squiggly volatility, whether we see it or not, right? So I don't think, in other words, I don't think there might be a lot of reasons for us to consider private equity to either increase it or decrease it or switch it around or
Yeah.
whatever. But I don't think the fact that it's reported quarterly
No,
and therefore we're hiding volatility from ourselves
no, that's not,
is a reason to,
I shouldn't have phrased it that way. Can we, let's rewind?
Yeah.
And let's
Mhm.
go to slide 22 and talk about actually why private equity outperforms. And I think that there, some of these reasons in here might inform other aspects, because you're right, it's not just a timing thing. That's, I shouldn't have said that. Okay, so why does private equity outperform? The first, and potentially also create lower volatility, within a portfolio. All right, so the first reason is asymmetrical information, level of due diligence. So within the private sphere, the concept of sort of material non-public information doesn't exist. Investors are able to use any information, all of the information that they can get their hands on. They'll look at company financials. They'll often have someone audit the company financials. They'll speak with management. They'll speak with the sponsors. So asymmetrical information and the ability to conduct due diligence with MNPI is a benefit. Private equity, typically for buyout transactions, it's control investing. So the private equity investor will often take a board seat and will oftentimes control the company. So buyout transactions, the sponsor looks to have when I say sponsor, I mean private equity firm, looks to take a 51% position or more. Growth equity, oftentimes there is in control, but in the buyout world, typically that's what you would seek to do. We also, as a co-investor, we also take board and observer seats, and about 25 to 30% of the time we'll either have a board or an observer seat as an active minority investor. Strong alignment of interests. So oftentimes management, and this is often different than a public company. We think that this is an important aspect of private equity. Oftentimes, the private equity firm that's investing in the company will incentivize management to deliver certain KPIs, deliver certain metrics, execute on the value creation plan that's put in place. And if they're able to do that, there's typically significant wealth creation that can happen at exit. So really strong alignment of interests. And we're talking significant wealth creation. So that's something that can be different. And usually, when a private equity firm is investing in a company, they work with management to get everyone on board with the value creation plan that's going to be executed. And unlike public companies where management is worried about a daily stock price or investing back in the business that might cause the stock price to dip, for a private equity firm, it's okay to since there isn't a public, the company isn't there's no daily stock price. The sponsor and the management team can actually take the time and invest in the business because they're not worried about the daily stock price. Typically, the whole period for a private equity company is 4 to 6 years. So even if they're investing in the business and maybe cash flow or EBITDA might go down at the beginning, which would cause the stock price to be, which could cause the stock price to be volatile, they don't care about that in the private equity market because they know that they're investing in the business for an ultimate value creation plan, for an ultimate return on a value creation plan. So they're not, the business isn't managed in the same way because daily volatility doesn't mean anything. What you're ultimately looking to do is to get to a place over a 4 to 6 year period where the company's worth more. And how, I'll come back to like sort of what that means. One of the other points is talented management. So oftentimes private equity firms will parachute in sort of like legendary CEOs to help a company overcome a specific challenge or execute on a value creation plan. So that's an important one. We already talked, so value-added investing, the private equity firm is typically is investing as an operator. And like I said, they'll parachute in people, take a board seat. Time horizon, 4 to 6 year period, they're able to invest back in the business. And then we talked a little bit about exit options before, IPO, M&A, and recaps. But let's now talk, I want to talk about sort of the value creation. So if you go to slide 23, how are these companies actually increasing value, driving value? So there are 3 ways. Leverage. So oftentimes, and when we're doing due diligence on a company investment, we're always very, we want to make sure that the company can sustain the leverage that it has. We are not interested in companies that are, have very high leverage multiples, but a company can take on a buyout, take on debt, pay it down over time, and create value for the equity investors that way. The second way, and this is really the one that we rely on, this is, and most private equity firms will say this, is increasing profits and driving EBITDA growth. So typically private equity companies are valued on an EBITDA basis. So it'll be like a multiple of EBITDA. So you might hear someone say, oh, a company traded at 8 times EBITDA. Well, that would be like the value, the enterprise value is 8 times the EBITDA. And EBITDA is sort of like a proxy for cash flow at the company.
EBITDA being?
Oh, earnings before interest, taxes, depreciation, and amortization. Yeah. Sorry.
Okay.
And EBITDA margin is a very important metric in private equity, and the goal is to grow that margin. And how do private equity firms do this? They help the company drive efficiencies. Is there a way to reduce costs? So that's one way. And then the other way is driving revenue. How can we increase revenue? So product expansion, growth into new regions, M&A, acquiring new companies. Those are all ways that a private equity firm will do that. So that's the main driver. And when we invest in a company, we want to see multiple levers that the company can use to drive EBITDA growth and become a more profitable business. The third way is multiple expansion. So I said before that these companies are often valued on a multiple basis, so like 7 times EBITDA. When we underwrite a business, we don't assume multiple expansion. Our models assume that we exit at the same multiple that we entered at. But if you're able, let's say you invest in a business at 8 times EBITDA and you're able to sell it, you're able to make that business better. Like whether you make acquisitions or you make it a more efficient company, you grow revenue such that you are a larger company and you can command a higher multiple. And even if you enter a company at 8 times EBITDA and sell it at 10 times EBITDA, you made a return there. So that's another way. Any questions on that? No? Okay.
I have a
So-
quick question.
Yeah.
Eric Caliber, just a question on the leverage. So as we've seen increased cost of corporate spending as a role in this paper and increased credit spreads, and it's a macro question, but it applies to the macro investment bucket. How are companies currently dealing with the increased cost of leverage, especially the non-profitable ones that may be in some of these funds?
Especially the what? I didn't understand that.
Eric, speak up.
Oh, I'm sorry, you can't hear me. So, did you understand the question on the leverage?
No, I didn't hear the end. How are these companies feeling about the increased cost of capital?
So yes, in the total private equity world, a lot of these companies may not be profitable right now. With
Yeah.
the increased cost to leverage,
Got it.
how is the private equity universe dealing
Yeah.
with it, and how are these companies dealing with it?
For companies that are cash flow negative, it's pretty like oftentimes those companies aren't levered, or the leverage is very minimal. So usually when we're talking, like usually the companies that have meaningful amounts of leverage are companies that are generating EBITDA, are companies that are cash flow positive. So like growth equity investment, like venture capital and growth equity investments, which are typically the companies that are cash flow negative, not profitable, they're either not levered or very lightly levered. One of the things that we saw when interest rates went up and the cost of capital increased is that the percentage of debt in the capital stack actually went down, which was great for us, great for HarborVest, because private equity firms that are looking to who want a control position, right? We talked about if you're doing a buyout transaction, oftentimes you'll want control. If you need if you're putting more equity into the business as opposed to using debt to get that, you'll need a partner. You'll want to bring in a partner like a BlackRock or a HarborVest to be a co-investor in the business alongside you. So that's one of the ways is we saw an increase in the amount of equity. And when we do due diligence, and when private equity firms do due diligence, one of the things that they need to make sure that the company can do is service its debt. So like we'll look at all, we'll analyze all the different coverage ratios. Companies, yeah. So it's certainly a key part of our due diligence. And it was definitely, we looked at we looked at a stat that like prior to the interest rates going up, the capital stacks, it was like most companies on average, equity was like 46%. And then after interest rates went up, the equity is an average percentage of the capital stack was above 50. It's like maybe 5%, closer to 60%.
Thank you for answering the question.
Right, of course. Okay, let's go to slide 21 and talk about the stages of the company and sort of like the life cycle of private equity. Okay, so there are a number of different strategies within private equity in terms of accessing companies at different stages in their life cycle. So venture capital is like the very first stage. So this would be investing in companies that are new, early. In some cases, it's investing in an idea, and these investments tend to be pretty risky. When you're investing in venture capital, you want to be with the top venture capital firms. There's a lot of dispersion in returns. So like a fourth quartile venture capital firm, you don't want to be there. If you're in a top quartile venture capital firm, there's the opportunity to significantly outperform public markets. The different stages within venture capital there's pre-seed, seed, Series A, Series B, Series C. Oftentimes these companies won't have leverage. To your question about leverage, they won't have leverage because they're just very early and they're very risky. Private equity venture capital firms often have a very high loss ratio. So like they may have, they may expect that 60% of the committed capital will ultimately return like nothing. But the hope is that they're going to have, 40% will be in winners. So like they're going to have a lot of zeros, but then they want to have a lot of, 5X's, and then they want to have a couple of like 20, maybe one or two like 20X's. And when I say 20X, I mean 20 times the amount that they invested in the company. Growth capital. This is actually a place where we are very active. We think of growth capital as Series C and beyond. The company may still be cash flow negative, so it might be an unprofitable business, but typically there's a path to profitability. The risks that these investors are taking are typically not product risk or scientific risk, but it's more about commercialization risk. How does the company get its product or its service to market and generate, basically become profitable? So growth capital. Now, when you're underwriting a growth capital deal, doing due diligence on it, you typically want the returns to be high. This is like a risk spectrum. So venture capital is very risky. You're underwriting to a higher return. Growth equity is slightly less risky. The company is a bit more mature. Maybe you're writing to a 3X multiple and a 30% IRR, internal rate of return. The next stage, and really the majority of private equity, like the sort of like the main segment, is buyout transactions. And this is, when a company is, oftentimes these companies are cash flow positive, EBITDA, they're value based on EBITDA. And typically the private equity firm will take a controlling position and will drive operational improvements over a 4 to 6 year window, after which time they'll look to exit, either by selling the company to another private equity firm, selling it to a strategic, And oftentimes private equity firms will buy a company because they're like, oh, this company would be so amazing for this strategic. I'm going to invest in this company. I'm going to get the company all ready. I'm going to make all these changes to it so that this company becomes very attractive for this strategic, and then ultimately sell it to the strategic. And oftentimes, even during the due diligence process, they'll talk to the ultimate buyer. So like that will be like there will be a plan in place. Buyout, we typically segment buyout by small, medium, and large cap. And we invest across that. And then there's special situations and distressed. These would be cases where a company may be experiencing a financial issue and need some sort of rescue financing, and private equity can also play that role. Okay, I feel like I've talked a lot. Maybe, and I know that we want to talk a little bit about the diagnostic. If we go to slide 24, maybe I can talk a little bit about the types of investments, and then I'm going to hand it over to Kyle, if that works. But are there any questions on what I've gone through so far?
Also, any questions on like terminology? There's a lot of private equity language.
Yeah.
Series A, Series B, does that all make sense to everyone just understanding the investment process or kind of horizon?
Those series, so like a Series A would be when it comes, so like a series A would be maybe like the first institutional round of capital. So like the company, maybe it raised a seed round with friends and family, and now and there are venture capital firms that invest in pre-seed and seed, but it's like A, B, C is like the number of rounds. So if it's Series D, it's on its fourth round of financing, and typically the company has reached certain milestones to get there. So they've continued to develop.
In theory, though, less risk as you go along.
Yeah.
It's still risky because it's very early in the cycle, but less on a relative basis.
Yeah.
I think you're seeing more now with companies staying private longer, getting out to Series J, because the amount of funding, but to Ray's point of maybe a bit less risky, the valuations are a lot higher, they're cash flow positive.
Yeah. Yeah.
Sorry.
Yeah, the Stripe investment that we did was like a series middle of the alphabet.
Yeah.
It's like a Series J or something.
We get to see you, probably. Tom, did you have a question? You look like you were.
No, just absorbing.
Anything up there for Nick or Eric? Or back there, or whatever you guys are? Okay.
Do you feel better? Do you feel better about the volatility question? I think a big part of it is that is the longer investment horizon, and the fact that the manager, when a sponsor is investing in a company, they have certain goals, certain things that they want to do with the business, and they typically will allow themselves 4 to 6 years to do that. Now, companies are valued, so like a private equity company is valued on a quarterly basis, and the two main types of ways a company is valued is through public market comps. So like if public market comps are going up, if there's a lot of volatility, and if you're valuing your business based on public market comps, then you'll see that at quarter end.
That's what, if I get into, that's what I've seen people do. I've seen people de-lever the levered investment, then use a public market comp to measure volatility artificially.
Okay. So
The way of backing into continuous volatility for a company is priced going forward.
yeah. Okay.
It's really a feature too, right? The return smoothing to reduce the behavioral bias so that we don't have to like get worried like that.
Yeah,
I mean,
if you go back to in the Liberty Day, whatever Trump called it. I mean, if you have a bounce back and you measure, 2 weeks before and 2 weeks after, or whatever number of weeks, it's going to seem really smooth in retrospect.
Yeah.
But if you de-lever and then deconstruct the equity of the private equity company versus the public market, you have a surrogate for private market volatility. And then you could say maybe one is lower than the other, but I think without doing that, you really can't.
I think the best way for us to look at this, and I think we go down a rabbit hole here, so.
Yeah.
Yeah, so I was afraid of that. Yeah.
Is that, I don't think it really has a meaningful investment, long-term investment, impact on us.
Yeah.
I think there is it could be a little bit of positive, being that we're a public pension fund in a fairly educated, aware town where people seem to be interested, and we have a very active board of finance and RTM and so forth. So maybe to some extent, not having daily ups and downs could be superficially beneficial.
Yeah.
But I think we should sort of just shunt it to the side.
Yeah, yeah.
I don't think but I do have a couple, if it's okay. Yeah, things that just because.
Well, if I could, Ken, the reason I bring it up is not so much for this meeting. I just think going forward, I would suggest, Ken's caveats to notwithstanding, that we focus on the benefits to a long-term investor.
Yeah.
Which would not include minimizing daily
Okay.
measured.
Yeah, got it.
I just don't think is with Ken's exceptional insight on the politics of the situation, notwithstanding, I think that's the only way I would worry about that.
Nobody calls me exceptional ever, so I really appreciate it. So I just don't scratch a few notes here. I think Josh has heard me say this, and it's a real bugaboo for me. So first of all, I appreciate it. So this has been an extremely useful presentation, number one. So thank you. I mean that sincerely. I think you're really helping us understand a product that most people don't understand, right? Everybody hears, oh, private equity, should be private equity. Nobody knows what it is and how it really works. So this is helping us out a lot. And I think you have more to tell us. You did mention something, and you mentioned it several times, about this business of being in the first or second quartile.
Yeah.
And you don't want to be in the third or God forbid the fourth quartile, right? So who sets out to be in the third or fourth quartile, right? In other words, there are no dopes in this business, right? All of your competitors are smart. They're all capable, right? Some are more capable, some are less capable, some are average capable, but the average people are capable. They gravitate into a very high-paying profession, hardworking, high-paying, and you tend to get smart people and a lot of resources, BlackRock, Blackstone, whoever, Goldman Sachs, Morgan Stanley, whatever. So you guys are smart, no question about it. I'm sure you do really good work and so forth. But you're not going in the morning and saying, well, I want to be in the third quartile. But somebody ends up in the third and fourth quartile.
I think you end up there, right? Like, you
And-
don't initiate.
And nobody sets out to. So I think it's, what concerns me, we've had, it looks like decent or even good performance over the last 10 years in private equity. I would argue it's, it's already this wall, that's my opinion. But what worries me a little bit is we're due to end up in the third and fourth quartile if we happen to have been in the first and second for the last 10 years, if you believe in some sort of reversion to the mean, number one. And obviously the fees, which you haven't gotten to yet, is a big component of that too, because the enormous fees, multiple layers of fees are eating into these returns.
Yeah.
And if you're not there. So I guess there's really no answer I'm expecting from you. I'm just pointing out that that's a concern I have, that everybody knows if we went out and hired anybody to be an advisor and they were involved in private equity, they would say the exact same thing. You're going to be very lucky with us because we're so good at this and we're going to get you in the first or second quartile. So I don't know exactly what the answer is, but I'm just expressing a concern I have about the product. Number one. Number two, I'm just curious. It just came to me as I'm sitting here. Would you consider Berkshire Hathaway to be a private equity firm? Certainly not in total. They own a lot of public equities and tons of cash, but would you consider them to be sort of a private? I mean, I read his letters, it's very amusing, and they own tons and tons of private companies that they own outright. He talks about how he never meddles. He does handshake deals and he finds very talented managers and then lets them just do their thing.
Yeah.
So they're not on top of them day by day, certainly no volatility in that sense. And there's zero fee for the investor, zero. He takes $100,000 salary. Buffett runs, I think there's 12 people who work at the head office. And I'm just saying that, would that be a proxy in some sense for private equity?
No, I wouldn't consider, I haven't heard that before.
It just came to me as I was sitting here.
Yeah, I would have to think about that and look into it and really understand what Berkshire Hathaway is doing. No, we wouldn't. I don't know, Kyle, what do you think?
I think I would just view it more as like a long-term perpetual investment vehicle where a lot of these private equity funds tend to be more episodic and will invest across a 40-year time horizon and then realize that.
So you're talking about exit strategy versus no exit strategy. I see Bragg's like his horizon is forever.
Right.
So that'd be a very good point.
Yeah.
I was thinking more in terms of the private companies, the no meddling, talented managers, highly incentivized, et cetera. Just a thought. It just came to me. And then I think I have one other question. But I guess the other question, which probably goes along with this first, second, third, fourth quartile issue,
Yeah.
is private equity's been a successful endeavor in general, based on all the numbers you've shown us over the last 20 years. I think that's what you've been
Yeah.
working. And in that period of time, not that private equity was a secret or a tiny business 20 years ago, but it was probably a fraction of the size it
Yeah.
is today, I'm guessing. So you have tons more money chasing. Now, there's also more private companies, that's probably a good answer, but tons more money, tons more talent, tons more firms.
Mhm.
And to me, that raises questions about the outperformance for the next 20 years. In other words, I don't really care about what's happened the last 20 years. It's interesting and it's worth talking about. But all we're worried about today is what we should be doing to position ourselves forward, right?
Yeah.
There's a lot of things that happened in the past. And Celtics won lots of championships. We may not win tons more, Boston, right?
Yeah.
But, so I guess that's another question, sort of a question. It's a comment as much as a question.
Yeah.
But I just have a lot of concerns about what, I'm curious, that one you could answer.
Yeah, I can
And I'm
take a stab.
curious what your,
So I think when people talk, okay, so people talk about dry powder, right? Dry powder. So that would be, there's been a ton of fundraising and all these private equity firms have raised all this money and they need to put it to work in companies. So actually, the amount of dry powder has been relatively consistent. It's about 3 years worth of deployment. So we look at this because it's a question that we have. So we measure the amount of dry powder. And I think, what is it? It's around 3 years, and it's been around when I say 3 years, 3 years of deployment. So like it would take 3 years to invest in. And it's been that pretty consistently over time. I would say that, when we're underwriting, so that speaks to valuations. So that speaks to valuations. So let's take a look at valuations. Actually, I have a slide in here on it because obviously the argument is this: well, there's a ton of capital in there, and only a limited supply of companies, and prices are gonna get bid up. So let's look to see what they did. And I was on that.
30.
What is it?
I think on slide 30.
30. Okay, thanks. So the graph so you can actually see, so let's I don't know if I'm raising here actually. Okay. So if you look at the bottom left graph, this is pricing, this is valuation of global private equity, enterprise value over EBITDA compared to the S&P 500. And here we've translated it into enterprise EV over EBITDA because that's how we price private equity. Private equity is still cheaper than the S&P 500. Actually, it's almost 4 turns cheaper. Right now, the average price, of your average deal is 12 times EBITDA. The S&P 500 is trading at 16 times. And we haven't in 2021. Sure, there's a ton of capital, valuations that went way up. We saw that, but
is that I'm sorry, Joe, is that an apples to apples comparison though? Because S&P 500 is made up of mature, ongoing businesses, and private equity is made up of.
Based in the US,
Sorry?
based in the US as well.
Yeah, but leaving that part, yeah. But I'm just saying that when we're comparing multiples of big, mature, particularly with the S&P 500, the 500 biggest companies in America, I think, versus startups and companies that aren't making money and all that kind of stuff.
that wouldn't be. So this is venture capital wouldn't be included in this. But
Okay.
Sorry.
Yeah,
Yeah.
I think to your point, that also comes down to investor scale.
Mhm.
And I think one of our key hidden tenets of our platform is to think about investing across the size spectrum. So not every PE manager is deploying 20 billion a year into all these big transactions. A lot of funds, might be 200 or 300 million in aggregate, and are playing in a much different playing field. So you can still find different pockets of the market where you can still achieve value without just committing to the biggest funds that raise the most money every single year.
I'm going to go back to Andy, to your example about Amazon. I mean, if you took out the Magnificent Seven from the S&P enterprise value to EBITDA, I would think your market would look a lot
It would come right
cheaper.
down. Yeah, you're probably right. Yeah, we can do that. Yeah,
That's a good point.
that's a good point.
And also, I think, just to build on that, I think the European markets are considerably cheaper than US markets right now.
Mhm.
So if you took European markets out of the global comp, that would
Yeah.
reduce it as well.
Yeah, and if you look at certain sectors, there are certainly sectors that trade way more than this. And there are certain sectors that probably trade less than this. So you're right there, yes.
European banking, I mean.
Yeah.
Ugly.
Yeah.
Really ugly.
I think just to address your first question, I think you had about third and fourth quarter, you can jump in. And
Yeah.
like, that's where secondaries are used a lot, you know, to optimize the PE portfolio, and you have to constantly monitor. And there's a lot of reasons people use secondaries. One of them being if you have to take down the target allocation in private equity, you want to take that down and sell some of the portfolio into the market. But also is you're monitoring your managers and you're saying, hey, we're not liking what we see here. Let's start thinking about secondaries before it gets to a point where no one wants it, right? That's just,
Yeah, no, that's a
yeah.
good point. No, that's a good point. And I would say that when you like, you hire a manager, you hire a firm, an advisor that you believe will provide you access to first and second. And why do you think that they will? You have to understand what their due diligence process is. So like, when we're looking at a fund to invest in, or because let's talk about funds, because the quartiling only applies to funds, right? Companies are different. So let's talk about the funds. Well, we have a list, you know, we keep a forward map of funds that are going to come to market that we think very highly of. And why do we think very highly of them? Well, we know the people at the firm. We think that they're great investors, and we've sliced and diced the data. So when they're raising a fund, they provide a data room of due diligence on the manager, on themselves, and they will provide cash flows. And oftentimes the cash flows will have attributes, so like geography and deal size and team member. And so we want to find, so we'll slice and dice the data, we'll slice and dice the cash flows to try and analyze performance across these different attributes. So we want to understand, how has the manager performed in the past in, you know, consumer deals of this size that this person led. And by the way, is this person who we think is really good, are they going to stay at this fund? Because if they leave, then this fund might go to the fourth quartile. So we want to understand, how are they compensated? What's their carried interest like? You know, like what's the cohesiveness of the team? So when we're investing in a fund, we'll write, you know, we have like a 60 to 80 page memo that goes into depth on all of these things. Typically, you know, there are managers that we've been investing with for 30 years and so we feel like we really know them well. And every time they bring us a new fund, every time they come to market with a new fund, we completely re-underwrite them from the beginning to make sure that we think the tenets of their strategy and their thesis persist. We do something called, and I'm sure other managers do this too, but we do something called the QPA, quantitative portfolio analysis, where we look at all of the performance attributes across the entire portfolio. And if we see that a manager has strayed from their strategy, like let's say the manager says, okay, I'm going to invest in middle market healthcare companies. And let's say suddenly they're doing like large cap healthcare companies. Okay, that is a reason where the company might move from a great performer to an underperformer. So we want to understand that they're going to be consistent and they're going to stay in their lane and they're going to do what they've done and what they've done that has historically generated strong performance. Now, if they stray from their strategy, that's a penalty. Like we might not re-up with them again. I'm not going to say the name, but there's a manager that we know very well, large cap US focused manager, that deployed a significant amount of its capital. So these funds are typically meant to deploy over 5 years. They got really euphoric and excited in 2021, and they deployed a ton of capital in 2021. So they didn't stick to their discipline. We expected them to deploy over 5 years. They didn't. Like that's a problem. And so when they come back to market, like we're gonna like that's not like there's a good chance we won't re-up with them because of that.
So if you're already in the fund, you're kind of.
That's exactly right. That's exactly right. And the analysis that we did beforehand that led us to make that decision was, you know, positive. Like at the time, you know, when we sliced and diced the data before, they were very consistent. They stuck to their strategy. They had consistently generated top quartile funds over, you know, like 8 prior funds. So like there was a level of persistence with them, and then they weren't disciplined, and so that's a problem.
So do you stick to vintage year funds versus like evergreen structures where there might be pressure to deploy like that and, you know, end up with lower quality names?
Yeah. So we raise a we raise a commingled fund probably every 2 or 3 years that invest in other funds. And when we're, the funds that we're investing in are not everything funds. They're typical, 10-year life, 10-year plus 2 1-year extension life, the 5-year investment period. The funds that we raise typically aren't evergreen either. They have a set investment period. Our funds have a 2-year investment period. We have one flavor of funds with a 2-year investment period. We have one flavor of funds with a 4-year investment period. We want funds, back to your pressure to deploy. One of the things that we diligence when we're talking to a manager is that they raise the right fund size, right? You don't want a manager that is like, I'm going to raise as much capital as I can because the management fee is going to be amazing. We want them to raise the right amount of capital for their strategy. And so we'll have an opinion on what that right fund size is because we'll know what their strategy is, and we'll analyze what the market is. And if they're trying to raise this giant fund for like a small market, like that doesn't make sense. So oftentimes we'll negotiate with the general partner to cap their fund. So we'll say you need to have a hard cap. So like once your fund reaches 2 billion, we don't want you to take any more capital.
You gotta be like a side letter or something.
Yeah, well, no, it won't, that wouldn't be in a side letter. We would want that to be across the entire fund, so we would want them to change the LPA.
Got it.
So the LPA is a limited partnership agreement that applies to all investors. And we would want, like, if an investor doesn't have a hard cap and we think that they should, then we would negotiate with them and we'd want that changed in the LPA. And that's the important lever that you would use such that they don't feel like they need to deploy too much. We want to understand what their addressable market is. And if they have a 5-year investment period, you want to know that there's going to be enough opportunity for them to effectively deploy their fund.
Mm-hmm.
Yeah.
Yeah, it's interesting. I think especially when it comes to some of these funds with secondaries, since that's, secondaries is such a hot space right now.
Yeah.
If you're to worry about something, right, it might be about deploying into secondaries that have lower quality, but obviously mark them to NAV right away, and then as they mature over 4 or 5 years, look pretty crap.
Yeah, exactly. Secondaries is an interesting space because you're right. The discount, I think that the discount that you get is so okay. So secondaries. So that's when there's a portfolio. So let's say I'm an investor in a bunch of private equity funds, and let's say I want to sell some of my interests because I don't want to be invested. Ray brought up this point, because maybe this fund is performing, or maybe I just want to manage my exposure, or maybe it's a cash management tool for myself. So let's say I want to sell all of my funds that are older than 2012 or something, sell in the secondary market. What you'll do is you hire a broker, like a Jefferies, for example, or Campbell Lutyens, and they would go out and they would find buyers. There are funds that purchase these interests, and typically they're priced on a discount to NAV. And obviously they want, the buyers want a big discount and the seller wants as close to NAV as they could get. I think that maybe one could argue that those discounts are cyclical. And when you're investing in a secondary fund, you want to understand exactly how much they're relying on the discount to generate their return. Because if you buy in, let's say you buy on 80 cents on the dollar. So let's say the NAV of the fund is $100. So when you assume ownership of that fund, you're gonna have something that's worth $100, right? Well, let's say you pay 80 cents, you pay $80 for it, right? At the next quarter end, you mark it up, right? So you've created this return from 80 to 100, immediately. It's you've created this return. The important thing is to understand what's going to happen to the portfolio after that. Is it going to stay? Is it going to stay at 100, or is it going to go up, or is it going to go down? If it's going to go down, then right, that's a bad investment. That's a bad investment. So, what we would say is that we have a secondaries business. Now it's very hard. Every deal is different, but maybe across a fund, maybe we would generate a third of the return from the discount that we're able to get at entry, and then 2/3 of the return from appreciation in the underlying assets. So when we're looking at a fund, we want to understand the value of every company. So we actually will model out every company in the portfolio to understand the potential for return of each asset.
Can I piggyback on that subject? Because it was on my list. Actually, I think you must have read, there was an article, I think it was in the journal in the last 2 weeks on this.
On NAV squeezing?
I guess that's a good term. And it actually blew my mind, actually, because I don't know why you guys would be in any other business than that, from a financial point of view. So I just want to understand this, because we are in secondary, right?
Yeah.
Yeah.
Lexington.
So they're buying discounted NAV pieces for all the reasons you described, right? Which, by the way, means that's exactly what they're worth, right? They're not worth the NAV, they're worth exactly what they traded at, right? You could think it's worth 100, but it's not, because it's worth 80. That's what it just traded at. And then they mark it up and they take their incentive fee on that. I just want to make sure I understand that's what the article.
Take their incentive.
I mean, they get, 2% plus 25% of the profits or whatever the deal is. And they're actually marking it from 80 to 100.
Yeah.
And they're getting 25% of that $20 markup.
So
So I just want to make sure I understood that article, that was that was what the article said.
I think that one was very specific to this evergreen 40X space, where I think they're kind of trying to time the market.
Oh.
Just the article was, if you're a secondary investor, you should go back and read the paperwork and find out if that is what they're able to do, number one. So I just want to throw that out there. Yeah.
The fund that you're in is, that's not what they're doing. The fund that you're in is a traditional limited partnership. And the carried interest isn't paid out like that. The carried interest is paid on when stuff gets realized.
Oh,
So-
that's great.
Yeah.
Okay, because I was going to ask if we can.
No. No, you're not, that's not. The article was about what Kyle was saying, was about private equity tender offer funds. So this would be an evergreen fund that goes on forever. It's an evergreen fund that is continuously offered, so you can buy in. Okay, so typical private equity funds have a fundraising period. They'll set a size and it'll have a life. So like a general partner, a private equity firm will go out and say, I want to raise $1 billion. I'm going to try and raise it in 6 months or 12 months. Once I have $1 billion, I'm going to close it up. I'm going to invest it for 5 years. And then after 12 years, hopefully all the assets will be sold. Usually
Right,
all the
what's the
assets will be
breathing
sold.
room to be investing versus where you wouldn't in evergreen structure?
Well, and
So you deploy maybe into lower.
Just to back up, evergreen structure would be like a continuous.
so an evergreen, yeah, so there's this whole theme in private equity right now of these 40 Act registered. So a typical private equity fund isn't registered with the SEC. It relies on what's called the 3C7 exemption. In order, 3C funds that rely on the 3C7 exemption but aren't registered can only accept qualified purchasers, right? So institutional investors or individuals with $5 million of investable assets or more. Private equity decided that they want to expand down into retail. So they launched these registered funds. There's lots of different flavors. There are tender offer funds, interval funds, non-traded BDCs, and the non-traded REITs sort of all fit within this category. Tender offer funds and interval funds are where you would most typically find private markets. Tender offer funds, specifically private equity. Tender offer funds are continuously raised, so you buy in at NAV. You buy it at NAV. So let's say you want to invest 100 million in it. You pay in your 100 million all at once. So it isn't called down over time. In a typical private equity fund calls that down over time, right? When you invest 100 million in a typical private equity fund, you don't give them 100 million. They call that capital as they do deals, right? But in a tender offer fund, you give it all at once. You buy in at the NAV, and the idea is that the NAV will appreciate and you can sell. Usually these funds will have some sort of liquidity mechanism such that you can tender out of your shares. So, for example, we have one. It's mostly doing co-investments, not secondaries. And investors can tender on a quarterly basis up to 5% of the fund's NAV, subject to board approval. And our fund doesn't charge carried interest. We actually don't have carried interest. But the issue about that is that some of these funds that do charge carried interest are getting paid on unrealized gains.
Right.
Right. And that's potentially a problem.
So can we ask you,
Yeah.
just an action bullet?
Yeah.
Maybe you can write this down. Can we double confirm that our fund, our secondary fund does not take any carried interest for themselves from simply marking up things they buy at a discount to anything?
Yeah.
It's more of a mechanic of the waterfall. In the more traditional funds, as Andy mentioned, you actually have to realize the capital. And then once you reach a certain hurdle rate, then the general partner can take their carried interest. To Andy's point, in some of these newer structures, there's a different waterfall mechanic that's based on unrealized gains.
I get it. I mean, but we're asking.
So
Yeah.
what Josh can do is look at the LPA and he can figure out exactly how you guys are paying your carry. Which, yes, it's not what that article was describing.
Sometimes that's mitigated by a clawback.
That was my next question, is what happens if it goes from 80 to 100 and then it ends up being sold at 70? What happens to the fees
We
then?
could include that, like maybe.
Yeah, maybe that'd be the second part of the question, but it wouldn't be moved if the first part was not a problem. Right.
Right.
I don't involve it. I remember that was one of the things coming in here today. I wanted to make sure that we can look into. I mean, we're in it, nothing we do about it, but I would just be interested.
Yeah.
Anyway. Continue.
Okay. All right, so,
You want to cover the modeling?
yeah, unless, did you guys want to talk about co-investments? I guess we kind of already did. Okay, let's jump into the model.
Sorry. Of course you.
Okay.
Second over.
It seems like we're paying multiple levels of fees across, all these
Yeah.
different companies that we're invested in to roll a lot of dice.
Yep.
And sure, for the most part, some of the dice might beat the market, right? But there's, right, the manager, there's like, what if we get a bad man? You make a mistake, or they just end up being not great, they end up in the fourth quartile, right? There's a lot of dice being rolled.
Yep.
And it only takes a couple really to hurt the investment. Whereas we could go for like a no fee, infinite horizon BlackRock B, which is currently on sale. Because
What?
BlackRock B, it's the non-voting shares of no, Berkshire,
Oh.
not BlackRock. I've got BlackRock on the brain. Berkshire B is on sale, right? Because above it.
Right.
So we could go for that infinite horizon, no fee, just buy. The fees concern me,
Mhm.
and all the dice being rolled do concern me.
Right.
I just want to put that.
So you're basically asking a private equity versus public market.
Yeah.
So let's talk about that for 1 minute. So the returns that
I think if we flip to slide 50 as well, that might,
Which one?
slide 50.
50?
Oh. Yeah. You wanna present it?
Sure. I think the first item at that point is ultimately the persistence of the outperformance. So in this slide, you're going back to 2005. Each black bar is the global pooled private equity IRR. And this is the net of all the actual investor fees. This is the true net experience.
Okay.
And ultimately, we can see here continued outperformance really across every single unique vintage year. And then in aggregate on the right-hand side, we can see that spread that Annie alluded to earlier, about 350 basis points. So through time, I think it's that aspect of compounding that outperformance on this annual basis, which ultimately leads to that outperformance.
One thing that you hit on, like double layer of fees, that's something that's something that's can be viewed negatively in private equity, and it certainly makes the asset class more expensive, right? Because all of the underlying managers that are in your funds are probably charging 2 and 20. The venture capital funds, and when I say 2 and 20, I mean a 2% annual management fee and a 20% carried interest. So that would be like profit sharing of 20%. And the venture capital funds are probably charging more.
Yeah, I mean, there's a lot of very, very well-educated, very expensive people managing all this money.
Yeah.
It's got to come from some.
Oh yeah, no, it's expensive. It's very expensive. One of the things that can make it more expensive is the double layer, because not only are you investing in those funds, but you're paying a manager to then pick those funds, right? So like they're probably charging a management fee and a carry. So, one of the objectives of many institutional investors is trying to figure out ways that they can access how can they access the asset class at a much reduced fee load? Like how can they bring down their fees? One way to do that is through direct co-investments. So direct co-investments I talked about before was when you invest directly in the company, typically alongside a lead sponsor. So we do that, like, and your friends do that. The manager would be an active minority investor. So we're a minority investor. We're not taking control. So we're not becoming the CEO of a company or doing the heavy lifting. That's a private equity firm that you start from 2 and 20. That's what they're doing. We're providing strategic capital so that they can get the deal done. Remember when I talked before about how when the cost of capital went up, the equity in the capital stack increased, right? So these private equity firms are looking for co-investors. These deals, when we co-invest in these deals, we're typically not paying any fee or carry to access the transaction. So why are they letting us in? Well, one, we're oftentimes a large limited partner in their funds, right? So we're investing in their funds, so we're important to them. And oftentimes to their large investors in their funds, they'll give co-investment. We also co-invest in deals. We co-invest alongside sponsors that might not be in our portfolio. Why do they bring us deals? Because they want BlackRock in the capital stack, right? So we'll invest and we won't pay any fee or carry. Our investors, typical private equity funds charge 2 and 20. Our co-investment fund starts at 1 and 10. So you're already getting down to half the fee load, right? So institutional investors use co-investments as a way to significantly reduce their fee burden. The other thing that we've done, and this is, I know that we're not talking BlackRock product, but so it's just out there.
That's okay. No,
Okay. The other thing that we've done, because our investors, so we used to raise commingled funds that looked like some of the funds in your portfolio that would invest in primary funds, co-investments, and secondaries all in the same batch. And so you're paying fees on the whole thing, right? We had investors that said we don't want primary funds, or we're doing primary funds on ourselves, or we want to come up with we wanted to determine the ratio of primary funds, co-investments, and secondaries. So we split it all up. So now we have a separate fund for co-investments, we have a separate fund for secondaries, we have a separate fund for primary funds. And investors can mix and match to create their own portfolio across these different buckets. Like I mentioned before, the co-investments, we're typically not paying any fee or carry to get into the deal. The one exception would be a fundless sponsor. We will invest alongside a fundless sponsor. What's a fundless sponsor? It's a private equity firm that doesn't raise a pool of capital, yet they're still doing deals. They'll raise capital from partners on a deal-by-deal basis. So we'll look at those deals. They can be very interesting. Sometimes in some of those deals, since they don't have a revenue base from a fund, they'll charge fee and carry. We bake that into our modeling. But okay, so we have that co-investment fund. On our primary fund, which invests in other private equity funds, one of the tough spots for those is the double layer. Like, is the manager's charging something, and then the underlying managers are charging 2 and 20 or more than that, and then the manager's charging something. So we said, let's just get rid of that. So for investors that come into our co-investment fund or our secondaries fund or any other alternative market fund at BlackRock, they can invest in our primaries fund on a 1-for-1 basis. So if they invest 20 million in some other fund, they can invest 20 million in our primaries fund, no BlackRock management fee, and we don't charge a carry. So we're essentially passing along our scale, passing along our relationships, passing along our due diligence into a portfolio of private equity funds without a double layer. Because the double layer, to your comment, makes the asset class really expensive, and the double layer isn't baked in here, right? This is the direct alpha of underlying managers, not the manager that you pay to give you access to these underlying managers. So we've tried to get rid of it because we totally agree with you. It is an expensive asset class.
Thank you.
Maybe flipping the diagnostic, 38 and 39 are both really just kind of high level summaries of your overall vintage year exposure and diversification. I think we can largely flip past these. On slide 40, this gets to your point of benchmarking and quartiling managers. So we see here the 2 different versions of a quartile.
You're on 40, you said?
On 40, yeah.
You're not.
So the quartile based on both TVPI, or total value of data, which is equivalent to the current NAV and a distributed capital, and then divided by what's actually been paid into the fund, as well as the IRR of each fund. So this is, I think, one way of thinking about benchmarking. The other way that some investors are now really starting to think about benchmarking is what's called a PME, or a public market equivalent. And it's basically calculating the implied public rate of return if you assume the same stream of cash flows. So capital call will be equivalent to buying that index, and distribution would be equivalent to selling that index. And that gives you an implied return that you can compare more evenly.
Have we calculated that for our stuff or no?
Unfortunately, we would need the underlying cash flows
I
to do that.
Okay.
I think at one time we had a benchmark as the Wilshire 5,000 plus 300 basis points. I don't know where that came up.
It's
Does that sound like a?
Yeah, this was the point I made earlier about you're using the Wilshire 5,000 is kind of the broad public equity index, and you gave yourselves a target of,
Right.
we want to outperform that by 300 basis points, and then you can compare it. We tend not to try and benchmark private equity to public market benchmarks, just given the daily valuation versus the quarterly lag. On a 1 quarter basis, it's gonna, to Tom's question earlier, there's just a lot of noise. It's not gonna make a ton of sense. Maybe over a 10-year horizon, that is a good potential benchmark of your opportunity set. Was I could have just invested in public markets, but I chose to invest in private markets. The fund has a 10-year plus 2-year extension life cycle. So I want to make sure that over that horizon, I outperformed my opportunity set, which was taking that money and investing in public markets.
Because I probably would have liked to have seen that slide 50 instead of using, the MSCI World, to maybe use that Wilshire and the 300 basis points and see what that looks like.
What's our mascot?
Doug looked at too.
So looking at this slide, at least on a historical basis, we've gotten either lucky or skillful, because we're first and second in all the large ones, and we're third and fourth in the 2 small ones, right?
Yeah.
Looking at the pension.
Yeah, I think it's important to note too, we've specified each individual benchmark universe that each fund is being related to. So this is not necessarily against the totality of all private equity.
Got it.
So as it relates to
All right, because it could be a crappy vintage and being
for that.
second, right, whereas it's already so wonderful.
Okay,
Okay.
strategy and
Correct. Yeah.
Right.
The one other point I might add is that for earlier funds, the benchmarking is less relevant because things change. When a fund, like, what I mean is for the more recent vintages, it's not set in stone, right? Because these companies have a 4 to 6 year hold period. And so there's a lot that can still happen.
Yeah.
So when do we think of benchmark becomes
I think really around years 5 and 6, do they kind of more get to the kind of steady state? To Annie's point, the first 4 to 5 years, it can be extremely volatile with different moves in underlying portfolio companies and fund
Just
performance.
thinking about the Harbor Vest 23 has no benchmark. It's very, very early vintage, but right, having a markup early on is going to put it in the top quartile, but they're still in the investment period of the fund. And so a lot can change over the next couple of years in those funds.
So, I mean, it's starting to get late, so I want to try, and one of the things I've pledged as the new chair is to try and see if we can have these meetings not go on, because we could probably talk about this all night, because it really is interesting. I'm not just saying, I'm really enjoying this discussion, and you guys are really bringing us a lot of good info. But look, we're going to have time, obviously, to circle back with some or all of you about whether or not there are going to be recommended changes to this, and whether or not we can make changes, right? Because we've made commitments here. This is the one part of our portfolio that's probably the least able for us to change, unless we want to let other people have a 25% discount.
And the crappy ones are pretty old at this point anyway.
Yeah, we don't want to get rid of the crappy ones. But I guess my overarching question is, being as objective as you can, you've done a lot of work on our portfolio, right? What's your take? You know all these guys. I mean, have we, by luck or happenstance, backed into a reasonably good portfolio of private equity investments? Or, and we're big boys here, and women, we can take it. What's your take on all of you?
Yeah, I think ultimately it's a really well diversified program that's been built up. Some of the more recent commitments are definitely somewhat chunkier relative to prior commitment sizes and earlier vintages, and they're quite young. So I think time will certainly tell how they kind of level out over time. But I think overall,
good portfolio. Good portfolio. Yeah.
I appreciate that.
I think if you look at the commitment level, maybe this will get us to the pacing study, right? There's a huge chunk where you didn't make commitments, but to maintain target, then there's progressive commitments of 30 million, 25, 15.
Well, I think that
right?
historically, maybe Eric can talk to this better than I can. you know, we brought in Vanguard, and they were very, very, he's very aggressive, but, you know, Harbor Vest was one of their big pitches to us, and I think we reinvigorated our private equity activity in the face of that. So I think that's why it looks like it does, when all of a sudden we have these big.
And I think the pacing that we'll walk through, I mean, there is the long period of investment while you have older legacy vintages that are distributing, right? We're going to later this summer and into the fall, talk about the strategic asset allocation, think about the IPS. You have set targets, and we again, think about this over a long horizon. We're not thinking about our IPS and saying, well, in 2 years, we'll revisit and change, especially when you have target allocations to private markets that are going to take time to build up. And you want to think about how do you keep that level, or how are we going to target that over time, because they are liquid, and you don't necessarily want to be overcommitted and then think about going to the secondaries market, taking that haircut, right? There's that balance that you're trying to draw. So I don't know, maybe Kyle, just some of the quick pacing on both pools of assets, because I think that can give you an idea and an illustration of, you know, what does a long-term program look like. We're going to revisit the IPS. 10% may not be the target that we all land on. It could be 15%, it could be 7%. That is going to impact what that pacing and ultimate distribution looks like. You've had a 10% target for a long time now. It's been at least since Vanguard was in charge. It was pretty similar a couple of years before that. So you were making commitments in order to maintain your SA.
Right.
So Kyle and Thomas.
Yeah, maybe quickly on 42 for the town of Fairfield employees. Ultimately, this is what we consider a runoff scenario, should the plan not commit another dollar to the asset class, and what it looks like in relation to the broader target. So that's the 10% dotted line, and the light purple is the actual projected NAV of the total private equity pool. So you can see in the bold in the bottom row of the table, that's your percent as a total of the NAV of the total program. So it's hovering around 11.5 and then kind of teetering off down into 9 and 10. And then really post year 4 or 5, that's when you start to see the distributions really start to come off the program, and the NAV continue to fall down.
But that's assuming no new,
This is no new outlets.
And I think
other than this includes this is all our committed.
everything committed,
Right.
and it implies future capital calls for anything that's been uncalled.
Right.
So it accounts for that, but just no new dollars being committed to
Got
moving interest. I think importantly here as well, there's no assumed rate of return on the total pool. That's why you see this black line being flat. So we can certainly imply some level of growth, which would probably show a slightly different story. Quickly moving to 43 then is ultimately one scenario of a projected pacing plan such that you would be slightly above in the near years and then taper out to more or less match that on an ongoing basis, more or less committing about 8 million per annum.
8 million of commitment, but some will be coming back in.
Correct. You'll see the distribution row. And then importantly, actually below that is your net cash flows. You can actually see that it more or less is projected to turn net cash flow positive on an annual basis. So it's more or less just accruing that capital over time.
That net cash flow also implying, as you get distributions, those can also fund capital calls. We don't have to sell down anything in the liquid part of the portfolio in order to raise those capital call commitments. And the net distributions, net cash flows in excess of that are going to come back into the portfolio as well, and be invested in the public market side of the portfolio.
Where does the 10% target come from?
That's your SA8. That's the current target in the act.
Okay. So we're over allocated.
Part of that is the level of commitments made and how much distributions you've seen from the legacy assets. Kyle or Thomas, if you want to add anything, but kind of near term, and this was also a comment that, you know, we've made as we onboarded, as we discussed, we anticipated the commitments that you made were going to lead to a slight over allocation. You have up to, I believe it's 15, maybe 20% allowable in the IPS to private equity. So there is obviously potentially going to be an above target NAV within PE, but it's all allowable within the.
So the argument for not assuming growth in the accounts is that other accounts would have growth as well. So it's kind of a rough offset. Is that right? If there's an assumed 10% target here.
Yeah.
And you're not building in any growth in the account, and the reason for not building in any growth is it's all relative to the rest of the portfolio anyway.
No, we should build in growth. So oftentimes when we'll do this analysis, we'll assume planned growth so that it won't be 0%. And the dotted line will go up because it'll be 10% of a growing AUM base that's rising. So the line should slope this way. We can redo it that way.
Yeah, what this is implying this is kind of a low level of commitment that you would potentially expect if you assume the plan isn't going to grow. If you're going to achieve the 6.9% overall expected return that you have, the commitment sizes would get bigger.
Right.
To keep up with that.
With a fixed
target. So this kind of, think about this as your low potential commitment level, kind of a low end of a range of potential future commitments.
Good.
There's one more, or one name would be, question, it's on fees. I just, in your, somewhere in the presentation here, I remember, and I've read it elsewhere, obviously it's just true. How did it come about, or how is it defended that the fees are charged on the committed capital and not on the capital that's deployed? This is a global question, not an attack on you.
Yeah.
I just find some of this stuff fascinating in terms of how it came about and how it continues.
So that's been fairly standard within the private equity industry for a long time. So I'm not exactly sure how it came about, to be honest. What I will say is that there's typically a step down after the investment period. So usually during the investment period, it's 2% or, and it has like some of the mega cap funds now are will charge 1.5%. So the percentage has gone down. So like 1.5% on committed capital. And I guess the thesis is that they're reviewing deals consistently.
They're looking, they're still working, they're not.
Exactly. They're doing due diligence on
They're looking for opportunity.
Thank you. That was very well said. I appreciate that. Put you on the side of the table.
Right, and I guess, and one being on the same question, which you've already answered, by the way, but it just, is that this business reminds me a little bit of the real estate brokerage business, right? In other words, you have somebody one day said, hey, we're going to charge 6% of the value of the house to be the broker to sell it. And incredibly, we're going to have that fee, whether the house is 100,000, 500,000, $1 million, 5 million, 10 million, 30 million, whatever it is, right? And obviously there are discounts and different firms will come off that number, but they kept this fact in spite of a lot of efforts, including Congress passing some law last year. It still seems to be about the same thing. So why isn't the amount of competition? And you did answer, you said some of these larger funds have cut fees a little bit.
Yeah.
But the basic structure of a very, very substantial annual fee and then a very, very large carry fee has persisted.
Right.
And this is really just a question of fascination on my part, because all the things I learned in school about economics and competition would say this just can't be, right? You have very sophisticated investors on one side of the table, and the numbers are just getting bigger and bigger and bigger, and more players are coming in. And you would think somebody would say, you know what, we'll do this for 0.5% and 5%, which would still be gajillions of dollars because you probably raise, trillions with that if it's a good team.
Right.
So I'm just wondering, nobody has, I'm not saying you have an answer for it, but it does interest me. I just don't understand why these numbers have stayed the way they are.
I think it's because performance has persisted. Performance has persisted. And there are definitely new entrants into the asset class for sure. There are new entrants coming in all the time. But a new entrant comes in and they typically want to charge what everybody else is charging, right? They don't view themselves as the discount player. And it's because that net return, which we were talking about, which is after fees, that has consistently outperformed. So private equity continues to command the prices that it does. And I will say that investors typically don't mind the carried interest. So the carried interest, which is that's based on the success of the fund. And typically you only take carried interest in a traditional private equity fund, so let's not talk about that article. But in a traditional private equity fund, you take carried interest, and there are different waterfalls, but that's after you've delivered return to your investors. And usually there's a preferred return or a hurdle, meaning that the investors typically in private equity, it's 8%. So the investor needs to make an 8% return before the general partner starts sharing in the profits. And usually investors are okay with that because it means that the general partner is aligned. Like the general partner is aligned in two ways. One is to the GP commitment. Remember we talked about the GP commitment at the beginning?
Right.
You said it's BlackRock investing at its own balance sheet. And I said, well, a little bit comes from the GP because the investors want to see that alignment. But where the real money's coming from is the carried interest. And that makes them hungry, motivated, and aligned to find the best deals for their investors. And you know what else it does? It helps these private equity funds retain their best talent. And one of the things that we do due diligence on when we're looking at a fund manager is we want to understand who's getting paid the carried interest. Because if all the carried interest is sitting with the founder, not good. We want to make sure that carried interest is seeping down into the team so that the directors and the vice presidents, directors, and the managing directors are really incentivized to perform because they have the opportunity to make a lot of money.
I think what you said, I'm just thinking, what you said initially is really the right answer, which is that performance has been good.
Yeah.
So in order for me to be happy with fees, performance has to be crappy, and that's not something we want either, right? In other words, if you had 10 years of terrible performance, I guarantee you the fees would come down dramatically, but that doesn't make anybody happy. Wouldn't make me happy. So,
But you're like seeing that play out in the hedge fund world too.
yes,
Where like,
yeah.
There's been periods of not so great performance and now there's pushback on cash rates. We don't want to pay management fee on the cash rates, right? But above and beyond where we're starting paying. And you're starting to see that come through too, but they went through a period of more mixed performance, so.
Yeah, good point. So it's getting late. Does anybody, George, anybody have any questions they'd like to ask? I know one thing I always ask, which I know you guys will say yes to, is that maybe Josh can be the point person, but inevitably, this is a smart group. Somebody's gonna, or a few people are gonna come up with some questions they didn't think about during the meeting. I'd love to be able to funnel them to Josh and then allow you guys, the experts, to be able to give us answers if possible.
I don't like to prolong this, but I'm sympathetic, Ken, to your making presentations as I have to the board. I have.
Yeah.
A question that could come up, and we don't need to answer it now, is what does the pullback from privates by Yale mean for the market? There's nothing to talk about right now, in my opinion anyway, but it's just, it's a local institution. There could be people who work there, are active locally. It could come up. So, is the Svensson model dead, or does it mean anything for the market, or is it just a unique situation at Yale? And like I said, I don't think we need to explore it now if they want to.
Maybe opportunity, but thanks.
That's the way of looking at it, absolutely. That's another way of looking at it. But I think it might come up with the Board of Finance.
Yeah.
A local institution.
Yeah, if you guys want to noodle about that. Yep. Okay. Anybody, remote have any questions? Eric?
No, I'm good. Thank you very much. Great meeting.
Yeah.
Nick, I saw that you played ice hockey at MIT.
I did, yes.
I did too.
Oh, you did?
Yeah.
Yeah, she was a lot better.
She probably was. Yeah. Back when there were still varsity ice hockey programs. Yeah.
I think the better question is, what was MIT's hockey team like?
I mean, we practiced 10 hours a week, played long seasons. We were solid.
Okay, this is genuinely excellent. I've been on the pension board now off and on. I don't really know. Maybe Eric knows better than I do, but certainly back to, pre-Madoff, actually. I've never had a better meeting than tonight. This was extremely helpful. I mean it sincerely. I appreciate it.
We're really fortunate to have you as partners and we thank you for your time as always.
Good. Thanks so much. What do we have to do here?
Motion dismissed?
Okay, do I have a motion to,
What to do, Drew?
Tom, anybody want a second? Second, George. Okay, all in favor?
Aye.
No, okay. Okay, great. Thank you, everybody.